Welcome back. This is Chart Overload. I am Ryan Mumy, CEO of Sollinda Capital Management. With me is Justin Greenhill, our Chief Investment Officer. Justin, are you ready to do another episode of Chart Overload?
Ready.
All right, let's jump right into it. First section, looking at the big picture. First chart takes a look at inflation, and as we see here, there's been a sizable jump higher in inflation.
Yep. So this chart is CPI, which for those who don't know, it's a pretty generalized measure. It's very aggregated, but it's kind of what the market looks at, and it's a headline measure of inflation. So oil, gasoline, anything to do with energy is one of the key inputs to this measure. So you see it high back in 21, 22, and has a recent spike.
Yeah, and I mean, it's back to the theory of higher for longer, right? Higher inflation for longer might be here, getting over the disinflationary impulse that kind of dominated the narrative last year. And moving on to the next one, looking at some weekly spikes in gasoline. We see here. I'm glad we're not headquartered in the Midwest right now.
I mean, on a percentage basis, super big moves, right? And obviously, this is what's contributing to the rise in inflation. But as we'll get to throughout the course of this presentation, and I think as we talked about in the last one, many markets are choosing to look through this, albeit the consumer may not have that benefit.
Yeah, because looking at high gas prices, it not only squeezes them at the pump, it squeezes the businesses that consumers buy their products and services from, which is a double hit on the consumer. And could it lead to some slowdown in consumer spending? Absolutely. But moving on to this next chart, we've got this, right? We've got big numbers from big companies on CapEx, on spending. This is a projection from Morgan Stanley. And these have continued to ramp high. Like every time we do one of these, which is literally every 2 weeks, it feels like these numbers just keep getting bigger.
Yeah, and based on recent announcements, some of them actually do just keep on getting bigger, right?
Yeah.
So, unlike the oil situation where so-called transitory and the market, wants to kind of look past that, thinking that it'll be resolved, the big, durable, multi-year theme that continues to underlie everything is AI, and in particular, AI CapEx. So this chart, you can basically see that the so-called hyperscalers are approaching 800 billion to 1.1 trillion spending CapEx in 2026 and 2027, which is, as you can see in this chart, massive.
Big numbers on a piece of paper, right? Or on
Numbers
a
have
screen.
lost meaning since COVID. Have
Yeah.
you?
They just let's just call them big numbers. And
Big numbers.
I
Yeah,
guess
bigger.
at some point, as we've talked about, investors are going to turn their eye towards not just these headline big numbers, but the monetization of these big numbers. When will there be an ROI on these big numbers, on this big spend? Moving on to the next chart, looks at job postings. One of the big headlines was Claude, the release they did years ago, a few months ago, was going to replace software companies. And this data just shows that there's actually been an uptick in demand for software developers.
Yeah, which is pretty interesting when you consider, but I guess you could say software is such a general category, and a lot of these big software companies, whether it be Microsoft or, Salesforce, that have underperformed pretty substantially during the environment that you just described. There's also a case to be made out there that they're going to become more efficient, and what the data might show here is that software engineers are getting hired by all sorts of firms because for now they're the ones who are going to be able to kind of spearhead these AI initiatives, right?
Yeah, and also the blue line is the total jobs posting on Indeed. The labor market hasn't necessarily weakened, right? And moving on to our next chart, it shows they've actually surged as the unemployment rate held steady at 4.3%.
Yeah. So it's a really interesting time in that, we talked about that the labor market was softening from a very strong starting point most of last year. And clearly, based on our first graphic, you would assume there's now a headwind to the economy because of higher oil. But what we actually saw as recently as today, Friday, May 8th, is that employment actually started to strengthen in the economy over the most recent period of time this year. So it, at least for the moment, it seems that the world economy and the market cares a lot more about the positive that is the AI capex, albeit with its own nuance, as opposed to thinking the oil shock is going to be a systematic headwind or a systemic headwind, I should say.
Well, and the labor market's not breaking, right?
It's the
So
opposite, right, as
right,
yeah.
it's not, and this, could what does this mean? This could mean the Fed's got a little more runway to not cut, because the economy's holding strong and, their policy isn't as restrictive as some would wanna make you believe. Moving on to the next chart, takes a look at, earnings per share growth, in this earnings season, which we're about 65% through the S&P 500 constituents has been, I mean, remarkable. It's been really good.
Yeah, and, tying that in with the stuff we've already been talking about, what's interesting is this obviously is looking back at Q1. Coming into this year, Q1, the economy was, at the time, softer than it was, since having recently accelerated. So this just goes to show that not only are companies finding different ways to increase earnings per share, but the stock market, in particular the S&P 500, is perhaps more of a representation of big companies, AI, CapEx, than it is just regular business throughout the country. So just like we talk about K-shaped in the consumer, there is a K-shape in terms of how profitable and durably profitable business is as well, in terms of the big taking much of that and the small being at a relative disadvantage.
Well, and one of the concerns was forward price to earnings ratios were really high, and what this shows is the companies have grown into those price to earnings ratio. Their current price to earning ratios are going to be lower than the forward ones because their earnings have grown into those forward projections. In next chart again takes another look at earnings, and this again just looks at beats versus misses, and the numbers are moving in the direction that would indicate it's healthy.
Yeah, I mean, you combine this with the labor market data, you would be hard pressed to say that there was any sort of significant weakness in either the overall economy, labor market, or even especially corporate America. So
Well, there could be, like, that's where people get miss in our opinion, and why we try and focus on data so much is you can always come up with a reason why things will break, but our question in positioning for our clients is, are they breaking? And the data thus far would suggest they're not. Moving into our section on domestic stocks, first chart looks at overall positioning relative to earnings growth, and there's a bit of disconnect there.
oh, this is a chart by Deutsche Bank, I believe here, but basically what they're looking to do is separate out what they'll call discretionary investor positioning, which is the green line. And, think that is basically any sort of asset manager, fund manager, et cetera, who basically is kind of having a view based on what they think of the economy, what they think of earnings
Computers, algorithms aren't driving it. They're not systematic.
versus, what would be considered systematic in this regard exactly is going to be probably some sort of price based or volatility based input. So what this chart basically shows is that while some of the systematic strategies have been buying back in over the last 3-4 weeks, there still is what at least this measure thinks is an underweight in terms of discretionary positioning. So all else equal, this is just another type of participant that could come in and start buying.
Yeah, it suggests the pain trade for them is to the upside, right? That they'll be buying into this strength. Next chart, again, another viewpoint views that this is from Bloomberg Intelligence. It says that the current run, the buying might be pushing into what's considered the manic phase.
Yeah, so these last two charts, we put them together intentionally because they basically show that depending on your time frame, two different time frames can actually have two very different indicators. So, if you look longer term, you're going to basically say that the market's probably, depending on what participant type you're looking at, neutral to a little bit underweight, if not getting into in line. But if you look very near term, as in, the last month, you've seen a big sharp move higher from what was the year to date lows. And as such, some of these indicators, which we're capturing here in this Bloomberg measure, shows that that could be overdone. And it's not really broad based either, even though most areas of the global market have gone up. You've really seen a few big tech companies, and in particular, semiconductor companies, anything to do with AI has gone up just in a straight line for about 3 or 4 straight weeks. So this captures that.
And historically, why do they show this? Historically, this type of while manias can last longer than you would think, they oftentimes precede times of extreme volatility. The old elevator or escalator up, waterfall down. But again, to be determined. Next chart looks at the sentiment relating to the Mag Seven. The biggest seven tech companies. And as you see here, that's at really low levels, lowest level since 2023.
From a price standpoint, we just mentioned it, but big tech, NASDAQ 100, Mag 7, there has been quite a catch up here over the last 3 weeks or so relative to what was underperformance for really going back to roughly November of last year. But this sentiment index you see here is disproportionately weighed upon by Microsoft, which, it and to some extent Meta have lagged behind pretty significantly Google, NVIDIA, and so on. And a lot of that has to do with either headwinds to software, or in the case of Microsoft, its involvement with OpenAI has kind of become an issue. And, in the case of Meta, we mentioned AI CapEx. They're one of the big announcers where it seems every earnings, they basically come out and just jack the number up.
Add a zero.
Yeah, and being no domain expert in AI, the overall takeaway from just trying to listen and read about it as much as possible is that the models that Meta is doing are being left behind by several of the other so-called hyperscalers. So they're plowing in a lot of infrastructure spending, but the payoff is being questioned there. As in Microsoft, the business models being questioned basically because it is software. So there's a lot of dispersion under the surface of the Mag 7 to the point which is weighing on sentiment in that area of the market.
And you move on to our next one, which looks a little broader based at the Qs, which is the NASDAQ 100 ETF, popularly traded, one of the biggest traded instruments daily. What we see here is people are piling into it, right? Some of the largest on record number of flows, meaning people buying the Qs here recently.
Yeah, big inflows. So, which, kind of makes sense. These are the biggest companies. They're the companies that earn the most money globally. They're, dominant in AI and in their space. And they underperformed really for since probably roughly October to November of last year. And just as it looked like it was starting to break down, with what was happening in Iran, we've had just snap back the other way that is on rival of probably some of the biggest, quickest reversals higher in history, maybe. And
Yeah,
this captures that big flows.
And comparing it to the last one where sentiment is souring on the biggest of big of these companies, this could signify what does it mean together? It could mean that there's a broadening happening place where people aren't just concentrating in the Mag 7, they're looking at the broader technology complex.
And it just, yeah, exactly. And it just represents a big, quick revival and risk appetite for big liquid companies.
Yep. Final chart in the domestic section. This looks at buybacks, which had come under pressure as CapEx and AI ramped, and this shows that they're back buying some shares. Which what does that mean? It puts in kind of a quasi psychological synthetic floor on some share prices.
Yeah, that's a good way to put it. Long story short, buybacks have been what many say is, if not one of the dominant drivers for 10 years from now, the past 10 years, being that these big companies continue to buy back their shares. One of the issues now that analysts are starting to talk about is with all this CapEx that we've been discussing recently, it's going to make these companies have less cash to buy back shares. At the same time, there's going to be some big IPOs coming, SpaceX, OpenAI, eventually, Anthropic, and so on. And there could be more supply in the market going forward. So that's potentially a theme worth keeping an eye on. But in the meantime, you see Apple buying $100 billion. What's really interesting here, Salesforce, which is down a lot and has suffered from this rout in software companies at large, they've stepped in with big earnings, tons of cash, and I don't think many people would have guessed Salesforce, a growth company for all these years, would be the second biggest buyback, in the market. So there's a lot happening under the surface, particularly when it comes to, again, the dispersion of technology companies and what they're doing, how they've performed, and so on.
And how they're responding, right?
How
Like Salesforce, they're nobody had it on the bingo card that they're going to be number 2 of the biggest companies in share buybacks.
Which is a vote of confidence, right? I mean,
Yeah.
for a company like that to really double down on buying their own shares, I mean, again, we're not trying to pick an individual stock, but just as Google was left for dead a year or so ago and then went up tremendously, going from a laggard to a leader in AI, there is a possibility that some of these software companies have been disproportionately considered a loser in terms of the AI revolution, and they might actually end up being able to utilize it or take advantage of it in some form or fashion.
Moving on to the next section, let's talk about interest rates and credit. First chart looks at the 10-year break-even inflation rate in the U.S. relative to Brent crude oil. And, as we see here, since the Iran conflict began, they went up. And some call it the war premium, but they are trading higher.
Yeah. Just to kind of unpack this, you hear people talk about interest rates, you hear people talk about inflation, and you sometimes hear people talk about real interest rates, which is the difference between the two. But this so-called break-even inflation rate is basically a market-based measure that looks out what does the market think about inflation either going up or down over a long period of time. And since there is so much uncertainty in that over the course of, this is a 10-year break-even inflation rate, many people consider that to be how the market views central bank credibility, right? Meaning that if there is inflation and this measure were to keep trending higher, the market is ultimately thinking that the central bank or policy at large is not going to be able to control that. And in this case, even though we have seen a move higher in inflation, break even inflation rate 10-year with oil, it's by no means become unanchored. And in the most recent Federal Reserve meeting, Jerome Powell talked about exactly that, right? When asked, what do you think the market thinks about your credibility? He referenced exactly this. So this is something to really keep an eye on, especially if inflation starts to pick up or stays elevated.
Yeah, and moving on to another section in interest rates, this takes a look at the 30-year U.S. yield, and it's kind of hitting what's called the ceiling, which is around 5% on the yield on the 30-year U.S. Treasury. We're back at it as we see over the last couple of years. It's hit it a few times, but not stayed there. But we're back. We're back there.
Yeah, this chart is very interesting, and for anyone who pays attention to the bonds or macro markets, this is potentially very important because not only can you see here that long duration bonds have not gone up above that level in a very long time, so there could be some volatility, a spillover associated to if it does, but perhaps equally importantly, if it doesn't, and this oil shock does start to be transitory, various market participants globally have been buying or even buying less treasuries or even selling treasuries over the last several years. So, if rates on this particular duration, longer duration, start to move lower, there is a possibility that if inflation is falling, AI is finally seeing to be deflationary, there could be a lot of money in the world that could pile into U.S. long duration bonds relatively quickly. So we're at the flipping point.
Yeah, and this goes right into our next chart. It just looks at the same thing, the 30-year yield over a longer period of time. The last time we stayed above 5 was pre-global financial crisis, right, in 2007. And as I said, this is a psychological kind of a structural barrier that many investors see as above 5 becomes a really big headwind to global and especially United States growth. And what's the other side of it if, you just painted a picture for it could go down with a couple of pretty easy things taking place. Well, if it goes higher, it, traditionally would cause a repricing of assets, especially longer duration assets. And what are longer duration assets is exactly what we just spent a lot of time talking about: growth stocks, tech stocks. So as Justin said, really interesting data point to pay attention to relative to history and the current backdrop.
Yeah, and just to kinda add to that too, a lot of what's been positive in the global economy for the past, year and a half, 2 years, in addition to the AI CapEx story, has been the expectation that rates are not gonna go up. If anything, they're gonna stay where they are or start to move lower over the next couple years. And the world has a lot of debt, corporate, consumer, government. So there's a lot kinda hanging on that, and, this might be, the thing to watch as far as what the market is saying about that real time.
Moving on to our next section, non-US happenings, AKA the tour.
Full tool
Uh,
off.
First chart just looks at emerging market equities. There's been a pretty sizable outperformance in 2026 with non-US stocks. Some will say US exceptionalism, meaning what's driven so much capital to the US, as Justin said, over the last 10 years, is that on its back foot. And it's also price to earnings. Price to earnings of emerging markets is around 13, and the S&P 500 is over 21. So are global investors looking for better deals in a global broadening economy?
Great question. That's a rhetorical question, I believe,
Yeah.
right? One
Well, you can
thing we
answer
kind of
it.
yeah, I
Make your
will
stand.
yeah, make my stand. You gotta have a view. So, what people have really forgotten here recently, because this is the second year now, 2026 is, at least so far, the second year in a row that emerging markets have notably outperformed. Going into 2025, and we had put out some graphics about this in commentary and I believe videos at the time, but going into 2025, this gauge of emerging markets had underperformed the S&P 500 every year but one for 13 straight years. So put that in perspective. We're on the second year of pretty significant outperformance, but that's following 12 of 13 years of underperformance, right? And if you look at this gauge in particular, the MSCI emerging markets, it's very heavily weighted towards Asia. So in this case, think Korea and Taiwan. And, Taiwan obviously is always and has been known to be at the center of the semiconductor world, Taiwan Semiconductor in particular, but it's really Korea that's driven this. And, they are a big player in the so-called memory market, which went from being cyclical to secular, as many call it, with, more demand emerging from the training of AI models require more memory. But nonetheless, that with some idiosyncratic things in Korea that we've talked about many times in recent months is just continuing to drive MSCI emerging markets to new highs here. So
And while Justin said, the weightings are very tilted towards Asia, moving to our next couple graphics, let's take a look specifically in Latin America at Brazil. They have a big presidential election coming in, what is it, October or November?
it's October.
Yeah, in October. And right now it's a dead heat between Lula, the incumbent, and Flavio Bolsonaro, which is the son of the previous president. They're in a dead heat for, according to polls, who's leading the way.
Yeah, and the reason we mention this is, emerging markets, as we said, have outperformed for what is the second straight year, and Asian markets, in particular Korea, Taiwan, have done such on the fact that they're very levered to AI and that sort of thing. At the same time, Brazil, which is really not doing anything in terms of semiconductor chips or anything of the nature, has also dramatically outperformed for 2 years, following a decade plus of underperformance. So we're seeing emerging market equity and currency strength pretty much across the board in countries that are fundamentally very different from one another. And in the case of Brazil, one can see here how just the odds on the election has changed very quickly. And over the last several months, the market response to that has even changed, So it's foreign flows into Brazil, we think, are the dominant mover of the market, but we're paying very close to what's happening idiosyncratically because we think it'll matter going forward. And if you go to the next chart, you'll see here that orange line is the Brazilian stock market, the headline index of forward price to earnings, and the blue line is the currency, the Brazilian real. And basically, despite 2 years of strength relative to history, you see both equities and the currency are still not, at least by very traditional measures, undervalued. So that just kind of makes us think that anything good or bad happening idiosyncratically is probably likely to be the next catalyst there, versus for some time now, it's been an external catalyst, which has just been capital in,
Yeah,
right?
back to our previous chart, the forward price to earnings of the broader emerging market complex is right at 13. We see here the forward price to earnings for Brazil is about 9, right? So there's some geopolitical risk priced in there because, the uncertainty with the election. And, Justin could do an entire TED talk on Brazil and their economy, but the two contenders have very divergent ideologies, and so there's some uncertainty there on what's the response going to be to the economy. And to Justin's point, that gets worked out, priced in. There's a lot of there could be some opportunities for Brazil to shine.
Yeah, exactly. And the way we continue to frame this, amongst ourselves and to, clients or whomever we talk to is that in all of these different countries right now, you've got very specific things that are happening inside of the countries that are very important. But at the moment, it's the big global picture that matters more. And we're closely watching if and when there is a transition there and, what that means for the assets of these particular economies.
Let's move on to our last section, commodities. First chart looks at just simple WTI oil. The price, obviously, you see it spike up on the Iran conflict, go down, go up, coming back down on the headlines, but it's settled in above 90, which is a substantial move higher from where it was trading for an extended period of time.
Yeah, that was my takeaway at this chart. You don't know if you want to be short with the recent highs as a stop or if you want to be long with the recent lows as a stop. Probably low confidence in either. But I think what we can say is that until this price breaks back down to somewhere close or where it was, before this situation with Iran, we have to assume higher for longer. And we think the longer that goes on, the more various markets are going to start to actually price that reality and might create some sort of divergent performance, right? Like we continue to talk about how there's these broad themes of money to emerging markets or money to AI. I mean, you keep oil a large percentage higher for a year relative to how it was for the past year, at least historically, incrementally markets start to price that reality. So we think that that's relevant right now across the board, not to make a call on oil, but to just simply determine, is it maintaining an equilibrium price higher than it was prior to the conflict?
Or is this still all mostly war premium? And as soon as there's an agreement, this collapses. And even if it collapses to 70 versus 60, there's a big difference to the global economy and cross asset class response at 90 than at 70.
Exactly. And right now, the market kind of wants to ignore all macro data because, it's going to assume that this happened, but it may actually, to your point, get undone very quickly. So there's
And the
really no.
counter, we talked about the counter. The counter is that, yeah, there's been this conflict, but it's driven a ton of supply online. It's driven the United Arab Emirates to leave OPEC, meaning they can pump whatever they want to pump whenever they want to pump. So on the other side of this, it could lead to even more supply, which puts pressure on the price to move lower, right? So we could, on the other side of this, fast forward who knows how long, instead of oil settling in the mid 50s, it could settle in the low 40s because there's just a glut of supply out there.
Yeah, I mean, you bring up a great point. Had this never happened and oil prices not gone up, whether it been U.S. shale, whether or not it be some of the production in Venezuela that they're trying to get back online. We mentioned Brazil.
The reserves
Brazil,
they found in Argentina.
they've got I think it's called the Vaca Muerta in Argentina. You mentioned UAE leaving OPEC to pump more oil. There's a lot of oil out there. The issue has really been trying to incentivize the private sector to go and produce it because they're really dealing against lots of uncertainty. They were dealing against regulatory uncertainty during the Biden administration, but then they're also dealing with the uncertainty of there might be a point in the future where demand just drops off and there's no way to really quantify that because you don't know the pickup of electrification and electric vehicles. So anyway, nonetheless, as they say in commodities, the cure for higher prices is often higher prices. This will likely encourage production coming online that wouldn't have come on before, and we'll see how that impacts the world. Back to the bond chart, it's all very connected right now.
Yes, 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 yes. And the next chart looks at open interest across participants relating to open interest in Brent futures contracts, one of the primary traded vehicles for around the price of oil for not only investors but also for suppliers, producers that want to hedge their exposure. What we see here is when the Iran conflict started, the open interest or the amount of volume being traded collapsed.
Yeah, this is one of those charts that could mean a couple different things. If you zoom out, you would actually be surprised maybe to see that open interest has been going down for some number of years now. And a lot of people suspect that, a lot of these participants that used to be involved in the futures market in this case are now, using bank products, swaps, counterparty type instruments to do more or less the same thing. So what we've seen a couple of times now is it really takes a shock of something to happen in the global oil market. You get a big jump in open interest like you saw here, price will readjust, but then once price starts to find an equilibrium, you tend to see, at least in the futures and options market, participation just kind of falls off a cliff. And that might mean that there's less speculators in the market relative to the fact that the economic participants, want to do their hedging or whatever in a different way. We don't know, but needless to say, the net takeaway is there is not a bunch of panic as seen through volume in the oil futures market at present. If anything, it's very calm.
Last chart looks at gold. This is just a price chart of gold going back, 3 years. And what we see here is a big run up into the 5,000 per ounce range, and it's consolidated quite a bit.
Yeah. So what was no doubt a crowded trade at the beginning of this year in all metals has now come off pretty substantially. So if you look at copper or even silver, it doesn't look too different from this chart. So we're very much paying attention to, now that a lot of that speculative appetite has been cleansed from a lot of these markets, now that oil is finding a new equilibrium, risk appetite seems to be coming back in the stock market, does demand for, be it gold or all precious metals, reemerge to anywhere near where it was in the the second half of last year. And that, again, tying it back, might be also connected to what interest rates do from here.
Which are connected to what oil does, right? I mean, it's, as Justin said, it's all connected. But that was our recording this time. That was Chart Overload. We appreciate you spending some time with us. Obviously, we're excitable guys about some charts. But if you have any questions, you want to talk any further, please reach out to us at info@sollinda.com, info@sollinda.com. We appreciate you tuning in, and we'll be back next time. Thanks.